Fellow capital investor, my name is Edwin Epperson, manager of Blue Bay Capital, and I am helping capital investors like yourself make wiser, more informed decisions. Today we are going to be talking about private notes. What are private notes? Well, in short, they are secured investments that generate reliable cash flow. As J.D. Rockefeller, or John D. Rockefeller, was famously known to say, own nothing, control everything. And that's really what private note investing or private lending is all about. Your control of assets. You don't own them, meaning you do not assume the liability and responsibility. So what are we going to be talking about today? We're going to be talking that notes are loans. You will see that. We're also covered secured versus unsecured lending and why you should lean or really focus on one aspect of private lending. The other is active versus passive. Yes, there are actually two roles that you can play in the private lending universe, if you will. One is an active private lender, the other is a passive private lender, and I will cover that. And then last but not least, I will cover Blue Bay Capital's turnkey solution and what that looks like and how it can potentially help you diversify and generate passive income through a truly passive investment. What is a note? A note is a physical representation of money that a person or an entity loans to another, with an expected date of return on the principal, along with a rate of return on the loan capital and the payment structure. In this case, we have a person or an entity with money that wants to lend it to a borrower. The lender loans the borrower their capital. In return, the borrower signs a note that the lender should create and gives it to the lender the same time that they receive the capital from the lender. The note is a physical representation of the lender's capital. The lender keeps the note in a safe place because it is a form of legal tender. You see, a lender can take that note, they can go to a bank, they can borrow against it, they can sell that note. There's a lot of things that they can do with that physical piece of paper that the borrower signs stating that they've borrowed that money. So it's extremely powerful. Let's cover the age-old question about lending is the note secured or unsecured? If the borrower were to use a credit card, for example, and this is a form of unsecured lending, the bank, I know in this example you're seeing the private lender, but the process is the same. The bank gives the borrower a credit line, also known as a line of credit. There is no underlying collateral. The loan is given based on the borrower's credit and the bank's belief that the borrower has the capability to repay that debt. However, if the borrower does not pay back the line of credit, then there is really nothing the bank can do to recover their money. Yes, the bank may choose to take the borrower to civil court if the amount is great enough. The borrower's credit will definitely be hurt. They may even have a unpaid debt recorded on their credit until the debt is paid off. But beyond that, there are no ways for the bank to actually take the borrower's other assets without a lengthy court battle. And then always the borrower can declare bankruptcy. And so in an unsecured debt, that bankruptcy is a death sentence. So let's look at the other side. If the borrower owns an asset, and in this example, it's a house, but it could be any asset that the borrower finds of value, the borrower pledges the asset in exchange for the lender's capital. The lender then loans the borrower the money, and in exchange, the borrower signs a note, also called a promissory note, because that's what the borrower is doing. They are promising to pay it back. Just so that you know, those two terms are interchangeable, but they mean the same thing. A note, a promissory note, it's both the same thing. It is this document that the borrower signs stating that they have borrowed a X amount of capital. But this is where the key difference is. At the same time the borrower signs the note and receives the money, the lender also has the borrower sign a mortgage or deed of trust in some states. The lender then records that mortgage or deed of trust in the county where the property is located. This mortgage or deed of trust is known as a security instrument because it secures the lender's note to that asset. Now, if the borrower does not pay back the lender, or if the lender violates the mortgage in any way, The lender can take back the whole asset for whatever the lender loaned. Hopefully, the lender was wise and loaned less than the asset was worth, and therefore, they could actually make more money. Let's look at what the actual case is if somebody doesn't pay. So in this case, we've got the borrower, unsecured loan. The lender's already made the loan, and now the borrower's making their periodic payments, whether that's weekly, monthly, quarterly, annually, whatever the case may be. The borrower was paying, and then of course something happened in their life, and now they cannot pay anymore. So what is going to happen? The lender becomes upset, especially if they at this point realize they have an unsecured loan. They're going to start to fret. Of course, they're going to talk to associates, they're going to talk to friends, maybe even an attorney friend, and the attorney is going to encourage them, let's take them to court, which is fine for the attorney because the private lender has to pay for their services. Now, the lender and the borrower both go to court, they dispute their case, and ultimately the courts will decide what is to happen. This can be a lengthy and cost-prohibitive process, not counting the court fees, especially if the private lender used arbitrage, meaning they borrowed money at a cheaper rate and then loaned it to the borrower at a higher rate, hoping to create what's called a yield spread. That can be extremely expensive. Okay, so at the end of the day, the lender may, and I want to emphasize, may get a judgment against the borrower. They may even be able to garnish their wages. However, the borrower can always declare bankruptcy. And in a bankruptcy, the courts will look at the borrower's ability to pay back all debt, secured and unsecured, and they will decide how much of each unsecured debt the borrower must pay back. The benefit with secured is the borrower has to pay back the secured debt in the case of a bankruptcy. Typically, in the case where it's unsecured, the courts will hand down to all unsecured lenders a pretty steep discount, meaning 20 cents, 15 cents on the dollar is all the lender's going to get back. At the end of the day, guys, the lesson is don't lend unsecured capital. Well, let's look at what does this look like when the lender actually has a secured loan. What is the outcome? Is it the same? The borrower suddenly stops paying because of an event in their life, right? So what can the lender do? Well, the lender takes their mortgage and the note to the court and they sue the borrower. This is called foreclosure. How long will the foreclosure take? Well, it honestly depends on the state, how long it takes for it to get through the courts. Were the loan documents created in accordance with state and federal law? I mean, there's a lot of things or determining factors that will dictate how long it takes for a property to go through the foreclosure process. In some states, like the state of Texas, because it is a deed of trust state and it is a non-judicial state, it can take 21 days and the lender gets the property back. In a mortgage state, such as in Florida, especially if the borrower fights it, you're looking at anywhere from 1 year or more to get the property back. So just know that the time frame for foreclosures is very dependent upon the state and the laws of that state. But due to the security instrument, the mortgage, the lender is guaranteed to get the property after foreclosure, which is why secure lending has no other measure of safety when compared to unsecured lending, and even more so when you are investing for generational wealth. Now, I do want to say there is a caveat. The first position lender is guaranteed to get the property. If you are a second position or even more junior position on the chain of title behind a senior lender, your chances dramatically reduce that. Well, number one, you will not get the property. But number two, you may not even get all your money back. And we'll cover that in a different video. So the last question you should ask yourself is, do you wish to be an active lender or a passive lender? Active private lenders must communicate and build the team that protects them throughout the loan creation process. The active lender must know how to vet each one of these actors in a loan file creation, as well as the language and the timing of when to request, review, and make a decision on the loan being made. This requires a dedication of time and continuing education that is very hard to do for someone who simply wants to be a part-time private lender or a truly passive private lender. On the other hand, if you want to be a passive lender, All you have to do is identify either a broker or an active lender and lend through them. They are able to take advantage of true leverage by leveraging the active lender's time, knowledge, and experience, and even team. They can passively participate in private lending without having to worried or concerned about setting up and running a private lending company. So what does Blue Bay Capital's turnkey solution look like? Well, this is exactly some of the ways that Blue Bay Capital's turnkey private lending solution can help. If you're looking for time freedom and you're concerned about how much time that you're going to be spending in doing this entire lending process, then we can handle the active lender side for you. If you're concerned about not having the experience to see the pitfalls of a potential deal, a borrower, or a project, leverage our experience and invest with confidence. If you're tired or you don't want to deal with tenants, termites, or toilets, the 3 T's, investing through our solution eliminates that. If the idea of truly understanding and using leverage of time, knowledge, experience, and even capital is appealing to you, then we have a solution. Last but not least, if you're looking for a way to diversify your portfolio as well as participate with other sophisticated investors, then I believe Blue Bay Capital's turnkey solution is for you. So really, the question is turnkey private lending for you? Well, if you're looking for truly passive investments for passive income, then I believe Blue Bay Capital's turnkey private lending solution is for you. If you're looking for lower risk yet higher returns than safer investments, or if you're looking for investments where you are in control, then my firm belief is that my turnkey private lending solution is for you. My name is Edwin Epperson. This is our website. This is my contact information. Please connect with me on social media, LinkedIn, or Facebook. Would love to have a conversation with you and discuss more about my turnkey private lending solution. That is it. I look forward to discussing more about our turnkey private lending solution and just general private lending education. Thank you. God bless, and have a great rest of your week.